Inflation was 21% and climbing fast. Paul Volcker began leading the Federal Reserve in 1979, confronting a nation in turmoil where prices escalated uncontrollably. The Great Inflation's shadow had lengthened for years with two major energy crises, one in 1973, another in 1979, driving up costs every sector. Consumer confidence was low, and average families struggled with an 8% year-over-year increase in prices, which then surged to 14%, then 20% in a few short years. People remembered paying 79 cents for a gallon of gas, and suddenly it cost $1.20, a shocking 35% jump. Mortgage rates were already at 12%, making home ownership difficult for many Americans, a widespread concern for nearly 3 years. Volcker understood that drastic action was necessary to restore stability and trust in the dollar. His approach was known as the Volcker shock, a bold move to tackle the beast head-on. He immediately initiated a policy of high interest rates, pushing the federal funds rate from 11% to over 20% in months, a move that sent shockwaves through the global system. The prime lending rate for banks soared past 21%, a historic high unseen in generations, causing immense pressure on borrowing costs across the economy. This tight money supply strategy was designed to choke off inflation's growth by making borrowing prohibitively expensive for businesses and consumers alike, a calculated risk with severe consequences. Industries like housing and automobile manufacturing experienced immediate and dramatic downturns. New home sales plummeted by 40% within 1 year, and car production saw a 25% reduction in output. Small businesses closed their doors at an alarming rate across 50 states, leading to widespread economic anxiety. Taming the beast came at a significant cost for millions of American workers. The economy plunged into a deep recession. Unemployment rates surged from 7% to over 10%, reaching 12% in some industrial states in 1982, an 18-month period of widespread joblessness. Factories idled, and countless households faced severe financial hardship, feeling the painful effects of these unprecedented policies. Despite immense public and political pressure, including strong calls from Congress and even threats from angry farmers protesting high loan costs, Volcker remained unyielding in his commitment to price stability. His firm resolve over a period of 3 to 4 years gradually began to curb the inflationary spiral. By 1983, inflation had fallen to just 4%, a remarkable reduction from its earlier peak of 20%. This period, though painful, laid the groundwork for decades of stable economic growth, a testament to tough decisions made during a time of extreme national economic peril, proving that the path to recovery often demands uncomfortable sacrifices for everyone's greater long-term benefit. The economy added over 4 million jobs in the subsequent 2 years, as stability returned a strong sign of renewed prosperity after a difficult 5-year battle to secure the nation's financial future. Rates climbed past 21%, an unbelievable figure. Paul Volcker stepped in during 1979 to lead the Federal Reserve, facing a nation in deep economic turmoil. Inflation was already 21%, and still rising fast, a menacing shadow that had darkened the economy for many concerning years. Two big energy problems, one in 1973 and another in 1979, had dramatically pushed up costs across nearly every single sector, everywhere. People felt truly scared, and families found it exceptionally hard to get by with overall prices jumping 8%, then 14%, and then 20% in just a few short years. Gas prices shot up sharply from 79 cents to $1.20, representing a shocking 35% increase at the pump. Mortgages were already at 12%, making owning a new home a distant and often unreachable dream for many across 3 long and challenging years. Volcker knew he needed to act fast and hard to bring back trust in the dollar. His bold plan, famously called the Volcker shock, was a brave and necessary move to truly fight this growing economic monster head-on. He very quickly raised key interest rates, pushing the federal funds rate dramatically from 11% to over 20% in a mere matter of months, sending shockwaves through countries and financial markets worldwide. The prime lending rate for banks went even higher, soaring past 21%, a historic record high, never witnessed in very long time, putting huge financial pressure on absolutely anyone borrowing money. This powerful strategy of keeping money extremely tight was meant to quickly stop inflation by making it super expensive for both businesses and regular folks to borrow money, a highly risky move with very big and widespread downsides. Industries like building homes and making cars felt the hit immediately and drastically. New home sales dropped by 40% in just one single year, and car-making output fell sharply by 25%. Small businesses shut down at an alarming and accelerating pace all across the 50 states, causing widespread worry and deep anxiety about jobs and personal money. The entire economy went into a deep and difficult recession, with joblessness climbing from 7% to over 10%, even hitting 12% in some crucial industrial areas by 1982. A full 18 months of widespread and painful job loss. Factories sat empty and countless households faced severe financial struggle, feeling the sharp pain of these very tough decisions. Despite huge pressure from the public and politicians, including strong pleas from Congress and even threats from angry farmers upset about their loan costs, Volcker stayed strong in his fight for stable prices. His firm commitment over about 3 to 4 years slowly started to bring down the fast-rising inflation. By 1983, inflation had dropped to just 4%, a truly amazing and critically important cut from its earlier high point of 20%. This difficult time, even though it hurt, set the stage for many decades of steady economic growth, showing that hard choices during extreme national money problems often lead to better long-term benefits for everyone. The country gained over 4 million jobs in the next 2 years, as economic stability returned a clear and encouraging sign of renewed wealth, after a tough 5-year battle to secure the nation's financial future and health. Factories sat empty, silent witnesses to widespread financial struggle. Paul Volcker's aggressive fight against the runaway 20% inflation sparked an 18-month-long battle for economic stability. His tough decisions continued to send shockwaves across the United States for an extended period. Mortgage rates had already hit 12%, making homeownership a distant and almost unreachable dream for countless families across 3 challenging years. Gas prices had jumped by a shocking 35%, increasing from 79 cents to $1.20 per gallon, hitting household wallets incredibly hard. The federal funds rate, which Volcker boldly pushed past 20% from its earlier 11%, dramatically slowed down all forms of borrowing, making money very expensive. This extreme tightening of the nation's money supply was specifically designed to crush the persistent 20% inflation, but it also severely squeezed both businesses and everyday people alike across nearly every single sector. New home sales plummeted by an astounding 40% in just one single year, devastating construction companies and workers. Car-making output fell sharply by 25%, crippling a key American manufacturing industry that employed millions. Small businesses shut down at an alarming and accelerating pace all across the 50 states, creating widespread worry and deep anxiety about job security and personal finances. The entire economy plunged into a deep and very difficult recession by 1982, with joblessness climbing dramatically from a previous 7% to over 10% and even reaching a painful 12% in some crucial industrial areas. This represented a full 18 months of widespread and painful job loss. This intense period of widespread job loss truly hurt millions of American families and communities. Despite immense pressure from all sides, including strong pleas from Congress members and even direct threats from angry farmers protesting their crippling loan costs, Volcker remained absolutely unyielding in his resolve. His steadfast commitment to stable prices continued for approximately 3 to 4 challenging and often controversial years. Slowly but surely, his firm policies began to deliver results. By 1983, the high-flying inflation had been successfully brought down to just 4%, a truly remarkable 20% reduction from its terrifying 20% peak. This difficult economic period, though undeniably painful, laid a crucial foundation for many decades of sustained economic growth and prosperity. The nation's financial health was slowly but steadily restored to a much more stable condition. Over the next 2 years, the country experienced a strong economic rebound, gaining more than 4 million jobs as economic stability returned. This clear and encouraging sign of renewed wealth marked the successful end of a tough 5-year struggle to secure America's financial future, proving that hard choices during extreme national money problems often lead to better long-term benefits for everyone.